Welcome to This Explainer. Okay, if you're diving into marketing or accounting, there is one absolute, undeniable truth you've got to learn right out of the gate. Even the greatest products on earth will not survive without great unit economics, period. So today, we're going to act as your virtual chief financial officer. We're breaking down the exact, real-world math behind pricing models in the incredibly high-stakes Chinese market. We'll look at the actual numbers, dissect the cost structures, and show you exactly why the price tag you choose literally dictates whether your brand thrives or dies.
Here's exactly what we're covering today. We'll start by defining your baseline cost, then move into direct-to-consumer margin math. After that, we'll look at the retail distribution trap, outline a China market strategy playbook, and finally, deliver the ultimate CFO verdict.
All right, part one, defining the baseline cost. Before you can even think about pricing, selling, or marketing anything, you've got to hit the factory floor. We need to figure out the absolute base cost required to produce just one single unit of our product.
So looking at our breakdown, your absolute minimum cost to make one unit is exactly 32.50 RMB. But let's actually unpack how we get there, especially for those of you just starting out in accounting. The biggest chunk of the pie? That's 17.50 RMB and variable costs. These are things that fluctuate directly with how much you produce. Think raw materials or direct labor. Then we have 12.33 RMB in fixed costs. This is your rent, your management salaries, the stuff you pay no matter what. Finally, we've got a tiny sliver of 2.67 RMB for capex or capital expenditures. That's essentially your investment in physical assets like factory equipment. You add all that up, and 32.50 RMB is your rock bottom absolute baseline.
Okay, moving on to part two, direct-to-consumer margin math. Armed with that 32.50 baseline cost, let's look at scenario A. This is where you sell directly to your buyers on massive Chinese platforms like Tmall and Douyin, completely cutting out the middlemen. To build an independent business that actually survives in this market, your target gross margin needs to be a robust 60%. Now, you might be wondering, why so high? Well, in the real world, that 60% isn't just pure profit you get to pocket. You need a massive buffer. You've got to pay for customer acquisition, platform fees, massive marketing campaigns, and just your everyday operations. If this margin is too thin, your business is basically suffocating before it even launches. So the step-by-step math here is straightforward, but honestly, it's where a lot of beginners completely trip up. You do not just add 60% to your base cost. Please don't do that. Instead, you take your 32.50 RMB base cost and divide it by the inverse of your margin. So 1 minus 60% gives you 0.40. Essentially, you're saying that your 32.50 RMB cost represents 40% of the final price. Divide 32.50 by 0.40, and boom, you reach a target price of 81.25 RMB. This formula is absolutely crucial because it guarantees that exactly 60% of every single sale stays with you as gross margin. What this calculation tells us is that your D2C selling price needs to land safely in the range of 79 to 89 RMB. That right there is your sweet spot. By pricing your product in this zone on Douyin or Tmall, you're ensuring the financial health of your product line. Plus, you're giving your marketing team the exact ammunition they need to run really aggressive, effective campaigns without accidentally putting the company in the red. Which brings us to part three, the retail distribution trap. Let's introduce a bit of a plot twist with scenario B. What happens to all this beautiful math when you rely on traditional retail and distribution instead of going direct? Well, it's a totally different ballgame and, quite frankly, a massive strategic divide. Unlike the independent D2C path with that comfortable 60% margin we just talked about, traditional retailers are going to demand a huge cut, usually somewhere between 40 to 60%. Sure, they provide the physical shelf space and all that foot traffic, but they charge a serious premium for it. And that means the pie gets sliced up very, very differently. Let's look at the harsh reality of that accounting. If a retailer sells your product to a customer for, say, 79 RMB, which matches our D2C price, they are absolutely not giving you 79 RMB. They might only pay you a wholesale price of 45 RMB. So subtract your 32.50 RMB baseline cost from that, and suddenly your actual margin is squeezed down to a microscopic 12.50 RMB. That's roughly 28%. For any startup, trying to survive on a 28% margin leaves you with basically zero room for error, unexpected overhead, or a bad sales month. And that incredibly tight margin leads us directly to a rather staggering number, 296,000. You see, when your margin shrinks like that, your reliance on share volume absolutely explodes. All of a sudden, your startup is staring down a massive break-even threshold just to cover fixed costs and keep the lights on.
Let's connect the dots on this one. Because you're only making 12.50 RMB per unit in this retail scenario, you literally have to push 296,000 units just to break even and survive that middleman squeeze. Sell 100,000 units, you're losing money. 200,000 units, still losing money. Just try to picture a warehouse stacked floor to ceiling with your product. You have to move that entire mountain of inventory before you see a single cent of actual usable profit. This right here is exactly why unit economics is the beating heart of your entire business strategy.
All right, let's zoom out a bit for part 4, the China market strategy playbook. Let's see how these micro-level numbers actually dictate your macro-level strategy in the Chinese market landscape. Based on the math we've covered, you really have 3 main paths to choose from. First up, the premium brand strategy. This means pricing between 80 and 120 RMB and focusing heavily on health, quality, and key opinion leaders. This secures those higher margins we want and honestly gives you the highest probability of survival. Second is the volume play. This is selling at a low price, primarily through retail. As we just saw with that terrifying break-even math, this requires massive funding, has an insanely high burn rate, and is just very, very risky. Finally, we have the hybrid approach. This is where you use D2C channels for that high-margin cash flow, but you carefully sprinkle in retail partners to drive brand awareness and scale. For most brands, this balanced math makes it the most realistic path to success. Okay, wrapping things up with part 5, the final CFO verdict. Let's put our chief financial officer hats on one last time. Consider this your ultimate cheat sheet for pricing survival.
There are 3 ironclad laws you need to walk away with today. Number 1, your minimum true cost is roughly 32 RMB. You can't ignore it, that is your physical reality. Number 2, your realistic market price absolutely must be greater than 70 RMB to protect that 60% margin need for marketing and growth. And number 3, if you price below 50 RMB, your margins will be so thin that you are mathematically, slowly but surely, killing your company. The math simply will not let you survive.
So, as you study these concepts and start modeling your own unit economics, you have to look hard at your costs and ask yourself one final critical question. Are you pricing to scale, or are you just pricing to die? Keep running those numbers, keep analyzing, and we'll see you in the next explainer.